Let's take a look at fund distributions in this video, understanding what is the concept of waterfall at the time of winding up of the fund. This is very important to understand for those executives who are working in hedge fund accounting because everybody here in the system, the limited partner, the general partner, are waiting to encash their returns for over a 7-year period or a 10-year period. And therefore, how this returns is going to be calculated, how these returns are going to be distributed is discussed right up in the PPM or the Limited Partnership Agreement LPA. This system of calculation of fund distributions is called as the waterfall methodology, which is what we're going to be discussing in this specific video. Fund distributions will normally be first towards the limited partners. There could be one, two, there could be five, six, any number of limited partners that would be mentioned in the fund structure. And the fund distribution entitlement also goes to the GP as well, right? Because the GP, apart from earning just the management fee every year, is waiting to encash all those returns on the winding up of the hedge fund. So the distributions form a very, very specific allocation methodology. And this allocation methodology is clearly mentioned in the hedge fund agreement called as the LPA or the Limited Partnership Agreement. The general partner, as we already have discussed before in another video, is the one that manages the funds. They have the full and complete management control, and they are responsible for trading in multi currencies, multi assets, and generating profits for the hedge fund and giving those returns to the investors. So the general partner literally is the runner of the show. They're the operating company because they're the ones who are responsible end to end, from formation of the hedge fund to getting in the limited partners to trading to closing down as well. Limited partners, on the other hand, contribute investments into the fund. Their contribution to the fund is restricted to capital contribution. They do not necessarily have much of a management control. Only if there is some kind of a fraud or some kind of a discomfort, there's some kind of operational issues with the hedge fund. Limited partners do not otherwise interfere in the day-to-day operations of the hedge fund. They have a limited liability to the extent of capital. So therefore, it's very clear that we understand limited partners are the ones who contribute capital, general partners are the ones who run the show with the contributed capital. Can a GP also invest in its own hedge fund? Sure, 90% of the time. Why 90%? Even more than that. They would be investing in their own hedge fund because that's like literally walking the talk, right? So, general partners are normally also the people who put in the money first into the hedge fund because then that's a show of faith that yes, if this hedge fund has to be successful, then the general partner also does a capital contribution into its own hedge fund. Let's understand the concept of a distribution waterfall. After multiple years of working in the hedge fund, of the hedge fund operations, the hedge fund is now winding up. Okay, and this is normal. Typically, this duration is between 7 years to 10 years. That the hedge fund closes down the fund, it winds up the operations of the fund, and the capital and profits, etc., are distributed back to the partners. Let's take this methodology that is followed. It's called as the waterfall methodology. Waterfall implying that it is a cascading fall. Okay, so it's one after the other, after the other, after the other. How it is paid is literally a waterfall methodology because it's a sequence of payments that must take place. First is the return of capital. This is called as tier 1. Okay, tier 1 is the return of capital. The first entities who get the capital back are the limited partners. The limited partners are entitled to getting their capital back on winding up of the hedge fund in the proportion to which they have invested into the hedge fund. This is the first tier. We'll be discussing each of these tiers in the upcoming slides. Tier 2, Pref. Pref is the word that is used for preferred returns, or in our hedge fund terminology as accounting executives, we understand it as the hurdle rate. So every hedge fund has a hurdle, okay? and the hedge fund performance is calculated as a benchmark against that hurdle. So the pref is the hurdle, it is the benchmark, it is the benchmark against which performance fees is calculated, and therefore pref belongs to the LPs again. Okay, so any kind of hurdle belongs to the LPs because the entitlement of the GP to anything above the hurdle is only the entitlement of the GP. Tier 3, catch up tranche. Almost all LPAs, limited partnership agreements, will have something called as a catch up tranche. This catch up tranche is largely a percentage of the performance of the fund over and above the pref. Okay, so you have to first pay the LP the return of capital, you have to pay the preferred returns, that's the pref, and then tier 3 is the catch up tranche. This catch up tranche is the excess over the pref, and that belongs to the GP. And whatever is left after that is called as a carried interest. This is tier 4, and this is normally distributed between the GP and the LP in a predefined percentage. I've just mentioned some numbers over here, but it's not necessarily the industry practice is 80-20, 80 to the LP, 20 to the GP, but it could be 82, 18, etc. It could be any amount depending upon the economic circumstances, the market circumstances, etc. So that is the distribution waterfall. Let's understand this. First, let's take a case of my favorite hedge fund, Hari Hedge Fund, which has a beginning AUM of $100 million. It has an end AUM of 150, no, that's $145 million. Okay, the initial capital contribution by the LPs is returned back to the investors. Okay, this is very important to understand. So that is marked in the red line over here. Initial capital, everybody gets back their initial capital. All right, the beginning AUM, the end AUM, everybody gets back their initial capital. Second case, how do we calculate the pref? Let's say the hurdle rate is 7%. The AUM in year 0 is 100 million. The AUM in year 7 is 145 million. The pref is 7%. So this black line, which is about 107, also belongs to the LP, that is paid to the LP. Okay? So now we understand the way the waterfall impact is happening, right? The cascading effect is called as the waterfall effect. Third tier, catch up 12% also is there in this particular limited partnership agreement. Every limited partnership agreement has a catch up which is due to the GP. Why does the GP have a catch up? Because the GP has to also earn something more than just the management fee. And at the time of entitlements, how do they calculate this catch up? So this catch up is basically the amount that is over and above the hurdle. So if you say the catch up is 12% and the hurdle is 7%, then 12% minus 7%, not necessarily in that order, but whatever is the excess about 7% of the hurdle, right, up to 12% is the entitlement of the GP. So that's marked in yellow line. Okay, so the red line, the black line, and the yellow line. So that's the third tier. And the fourth tier is the carried interest. Anything more above that. Okay, so above 112. Anything above 112, right up to 145 is then distributed by way as carried interest. I've already uploaded a detailed video on carried interest. I'm sharing the link of that video in the comment section below. So that if you have any doubts about carried interest calculations, you will understand that it is very important to give the carried interest in a particular proportion between the LP and the GP, because the LP has actually just been paying the management fee all along, right? And they also need a contribution, sacrifice quotient, that is their entitlement. So these are the 4 tiers. The first one is the return of capital, the second is pref, The third is catch-up tranche, and the final one is the carried interest. Distribution waterfalls can also be either American distribution waterfall methodology, which is a deal by deal methodology, or a European distribution waterfall, which is a aggregate fund level. We'll be discussing about American distribution waterfalls and European distribution waterfalls in another video. If you like the content in this video and you're interested in a career in global markets, in operations, processes, and regulations, in trade life cycle, fund accounting, ODC derivatives, and custody operations, do hit the like, subscribe, and comment section on my YouTube channel. Thank you very much.